If you want long-term growth without the stress of picking individual stocks, ETFs are your shortcut. Forget the hype and the endless research today. I'm showing you the proven ETFs to build a durable, powerful growth portfolio. We'll look at the real numbers and break down exactly why each one matters. ETFs aren't just a trend. They're dominating the investment world in 2025 for a reason. This year alone, investors have poured over $900 billion into US ETFs, a clear signal that people crave low cost and instant diversification. This isn't a fad, it's the new foundation for building serious, long-term wealth. And it's a strategy you can start using today. Your portfolio needs a strong core, and an S&P 500 ETF is the perfect place to start. Vanguard's S&P 500 ETF, VOO, is a titan in this space, managing hundreds of billions in assets while charging a rock-bottom fee of just 0.03% for decades. Large-cap U.S. equities have been the undisputed engine of wealth creation, and VOO is the simplest, most efficient way to own that engine and capture the market's long-term growth. For even broader exposure, look no further than Vanguard's Total Stock Market ETF, or VTI. This fund goes beyond the S&P 500 to include small, mid, and large-cap companies all in one ticker. It also costs a mere 0.03% but gives you access to thousands of stocks, capturing the innovation happening in smaller companies that the S&P 500 misses. These smaller firms can be a powerful driver of extra long-term returns. If you're looking to add a high-octane growth tilt to your portfolio, Nasdaq 100 ETFs like QQQ are your answer. This fund concentrates on the mega-cap tech and innovation leaders, the companies building our future. Over the last decade, QQQ has delivered outsized returns, with a 10-year annualized performance in the high teens. But remember, with higher returns comes higher volatility. Use QQQ as a strategic satellite holding, not the core of your portfolio. Growth ETFs are powerful, but income helps smooth out the ride, especially during market downturns. This is where a quality dividend ETF like SCHD shines. SCHD focuses on high-quality companies with a history of growing their dividends and currently yields around 3.7% to 3.8%. This provides you with a steady stream of income plus potential downside protection when the market gets choppy. So, how do you put this all together? A simple, durable allocation could look like this: 50% in a core holding like the S&P 500 or a total market ETF VOO, VTI, 25% in a growth-focused ETF like the Nasdaq 100 QQQ, and the remaining 25% in a dividend or defensive fund like SCHD, perhaps with some international exposure as well. The key is to automate your monthly purchases. Use dollar cost averaging to your advantage, and rebalance just once a year. Don't underestimate the impact of fees and discipline on your long-term results. Keeping fees low is critical. The difference between 0.03% and 0.3% can compound into thousands of dollars over the years. Use tax-efficient accounts like a Roth IRA whenever possible. Finally, make it a habit to rebalance annually. This forces you to sell portions of your portfolio that have outperformed and buy those that have lagged. A discipline that can boost your long-term performance more than trying to chase winners. While ETFs significantly reduce single stock risk, they are not risk-free. It's important to pay attention to factors like overall market valuation, sector concentration within your chosen funds, and your personal time horizon. Growth-heavy ETFs can fall hard and fast during corrections, while dividend funds can be hit if cyclical industries struggle. Always make sure the ETFs you choose align with your individual risk tolerance. For the vast majority of investors, a low-cost core of S&P 500 or total market ETFs, combined with a growth satellite and an income anchor, is the smartest and simplest path to achieving long-term growth. It's a proven strategy that takes the guesswork out of building wealth. Which ETF will you add to your portfolio this month? Let me know in the comments below, and don't forget to subscribe for more clear, actionable investing playbooks.